Okay, so we are going to look at what we call a cash generating unit or CGU. Okay, so the one that we look at impairment on a single asset that can independently what generate a cash flow on its own. That is the impairment that we have looked at. We are going to look at a group of assets that cannot generate what cash flows on their own. Before they can generate a cash flow, they have to depend on what on other. So it means that if you are looking at these assets, if you take one asset as a single asset, it cannot generate a cash flow independently on its own. It has to depend on the activities of other assets to be able to to generate the cash flow. So this particular asset, they generate a cash flow as a group. Maybe they work as a group. Individually, they can't do anything, but in a group, they can do something. All right. So mostly I use provision store as an example. So the provision store or a branch can be seen as what? A cash generating unit. So a provision store, you see, you are going to be having the land there. If the land is there, the land itself cannot what? Sell the things that you want to sell. You need a store, which is a container. Container alone cannot be able to sell whatever you want to sell. So you need tables. The table alone cannot be able to sell what you want to sell. So you need the items to put on the tables. You need maybe a deep freezer if you want to sell drink or pure water. So it means that for you to operate the provision store, you need a group of assets that will come together to make the provision store what? Functionable. So you need the land, which is there. You need the container, which you are going to have. You need maybe the lightning in the store. You need that. You need the things that you are going to sell, which will be classified as a stock. You also need the table, and maybe you need someone that can supply the thing to you on credit. So if the creditors are not there, you cannot be able to sell because you don't have cash to buy. So as a group, the provision store will now become a provision store, which the land is part, the container is part, the tables is part, the creditors, people that you are buying on credit, the stock, and all those things is part. So you have to put all these things together before you can operate the provision store. In that case, the provision store can be seen as a cash generating it. So a group of assets that determine what or that generate a cash flow independently as a group is what we call the cash generating unit, or a group of assets which each of them cannot cannot generate a cash flow on their own. They can only do so when they are being put together as a group. So that's what we call the cash generating unit. There might be a situation where a cash generating unit might also impair. So the provision store, if there is a heavy downpour, there is a heavy rainfall or downpour, it is likely that a lot of things might happen. So maybe the place was flooded and the stocks and those things, maybe the lighting, the table and those things, the things are not in a good condition again. And you have to test for an impairment. What do? You have to test for an impairment on the group as a whole. Any impairment that you are going to get must be allocated on the what? On the asset that has been impaired through the what? The incident. So if you get the impairment on a cash generating it, you are going to have a group of assets in the cash generating unit. So you ask yourself, which of them are likely to be impaired, and how do I allocate the impairment loss among them? So the first one is, if there's any impairment, the first allocation should go to assets that is physically damaged or physically damaged assets. Physically damaged assets. So it means that after the heavy rainfall, the lightning is now bad. The bulbs are gone. You can't see the bulbs again. It means that if there is any impairment, the bulb will be the first thing to take it because there is no bulb there. It means that the value of the bulb is now what's gone. So the bulb will be the first thing to take the share of the impairment loss. Okay, so the physically damaged assets, The next one will be a goodwill. Goodwill. Okay, you can't be saying that you have a good name and you are having a what? A loss. There's an impairment loss. So now you are saying that you have the location. The location is giving us a goodwill. It's giving you a goodwill. Now there's a heavy rainfall, and now the place is what? Clouded. You can see that you are likely going to move your what? Your provision store to a different location. It means that that particular location will not be a strategic allocation to you again. It will not be giving you advantage again. So it means that the goodwill relating to the location has also impaired. You are not going to be enjoying it again. So the goodwill must be taken off. So the next one is a goodwill. If after the physically damaged assets, there's any impairments left, goodwill should take. After the impairment to the goodwill, there's another one. What will happen is that you now what allocate the remaining one. You allocate the remaining on pro rata basis to other assets. So allocate on pro rata basis to other assets. The other assets can be land, can be the container or the building. So the assets that are likely to be impaired, which the non-current assets. If you have receivables, maybe if they are saying that it is likely that part of the receivables will not be received, then the impairment loss will also come to the receivables. But the question will always tell you that the net realizable value of the current asset is the same as their current value, with the assumption that there is no impairment on them. So the impairment will be will always be allocated to the non-current asset, which will be the land, building, equipment, and those ones. But if there is something that the receivables is also going to be reducing, there will be an inventory where they are saying that the cost, the net realizable value, and then the cost of the inventory is this amount. If the inventory is reducing, then the inventory will also take part of the sharing of the impairments. So the question can say that the receivables that you have is 20,000. Now the company is likely to receive only 18,000. It means that the receivables are impaired by 2,000. So when you are sharing the impairment loss, receivables should take 2,000. The question can also say that the stock is having a cost of 25,000. Now their net realizable value is 24,000. Okay. So it should be the lower of the cost or this one. So it means that the inventory will be carried at 24,000. There will be a loss of 1,000. This loss is also technically called impairment. So if you're sharing the impairment loss, 1,000 should be allocated to the inventory. But all the time, the question will tell you that the carrying amount of those ones is the same as their net realizable value. So we don't do anything there. So this is how we do the impairment on cash generating units. The impairment is the same, the carrying value of the cash generating units compared with the carrying or the recoverable amounts. Any impairment loss will be shared in this proportion. Okay, let's pick a very simple question from that area. Then we move on to a reversal of impairments. Then we look at what we call okay, let's look at the question 6 over here. It's very simple. It's very simple. It's not any. Sinanik, are you there? Question 6.
The net assets of Fanga SCG are as follows: PP allocated goodwill, product patent, net current asset. As a result of adverse publicity, Fanga has a recoverable amount of only 200,000. With reference to relevant IFRS, demonstrate how these transactions should be accounted for in the financial statements of Fanga.
Okay. Okay, this is very simple. This is very simple. Okay, so what is the carrying value of What is the carrying value of the cash generating units before the impairment test? What is the carrying value?
300,000.
Okay. What is the recoverable amount now?
200,000.
Okay. So there is an impairment of what?
100,000.
Okay. The impairment of the 100,000. So I'm going to use this to explain a lot of things. You see, after this one, the question can give you, they can give the net realizable value of each of the items here. Okay. They can say that the net realizable value or the fair value or the net realizable value of property, plant, and equipment. Okay. They can give it to you as 250,000. Or they can give you that the fair value of the property, plant, and equipment is 250,000. Okay. They can also give you the product patent, that the product patent, the fair value is 15,000. Okay. They can give you that. Okay. If they are giving you the PP is having, the PP is having, they are telling that the PP is having a fair value of 250,000. What does it mean? In relating to the impairment, what does it mean? The carrying value of the PP is 200,000, but they are now telling you that the carrying value of the PP at the date of the impairment test is 250,000.
PPF.
What does it mean?
It means that the market value of the PP has increased.
Okay.
Which
And
will be,
okay. Yes, you can
which will
continue.
mean that
Okay.
there is a revaluation of the assets.
Okay. Okay. But I want you to relate it to the impairment.
Impairment.
What does it mean? If you are coming to an impairment, if you are allocating the impairment to each of the assets, what does it mean? The PP is having 250,000, but the carrying value of before the impairment is what? 250,000, 200,000. What does it mean?
It means that the PP has not impaired, has not decreased in value, and so there will not be any allocation to the PP.
Exactly. So it means that the PPE has not impaired. So if you are allocating your impairment loss, you exclude the what? The PP, because there is no reduction in the value of the PP. The PP is having a value higher than the what? The carrying value. So there is no impairment on the PP. That is if the PP is carried under cost model. If the PP is carried under the cost model. The PP is carried under the revaluation model. It means that you first revalue the asset. And that is also means that there is no what impairment on the PP. So you revalue this one and recognize a revaluation surplus of what? 50,000. Meaning that the fair value of the PP at the date of impairment is 250,000, indicating that the PP has not what? Impaired. Okay. But your impairment loss is still 100,000. What do you do? Good, there's no physically damaged asset over here. Goodwill will take what? 50 what? Thousand. It will be remaining what? 50,000. Okay. The 50,000, they are now telling you that the net realizable value of the patent is what? Is 15,000. And the patent, the carrying value is what? 20,000. It means that the patent has reduced by only what? 5,000. So you only allocate what? 5,000 to the patent out of the what? The 50,000. The remaining 45,000, I don't know what you are going to do to it because you can't allocate to any other asset. So you just leave it. So they can give you the recoverable amount and then the carrying value of the cash generating unit. And they can also give you their net realizable value. You cannot reduce the carrying value of the asset, the individual asset, beyond their net realizable value. So you can't say that the impairment is now 50,000. So you are going to allocate all the 50,000 to patent. You are going to take all the 20,000. No, you cannot reduce the value or the carrying value of the what? Of the impaired asset beyond their net realizable value or the value in use. So they can give you these things. You have to know if the value is higher, it means that this particular asset has not impaired. You won't allocate the goodwill to them. But there's nothing like this. There's nothing like this to this one. So it means that the PP is likely to be impaired, the patent is also likely to be impaired, then we just share this one to them. So the impairment loss is 100,000. Okay. So what will be the first thing? Physically damaged asset. We have none. So the first thing that we'll take is goodwill. Okay. Goodwill will take what?
50,000.
Okay. Goodwill will take the 50,000. Okay. So it will be remaining what? 50,000, isn't it? Okay. And the 50,000 will now be shared between the PPE and then the patent. You consider the current asset, they are giving you the net realizable value. So this is their net realizable value. You are going to realize all the what 30,000. There will not be any reduction in it. So impairment will not count to this one. But since there is nothing concerning the patent and then the property, plant, and equipment, we assume that they are the one that is going to share the 50,000. Property, plant, and equipment is 200,000. Patent is what? 20,000. So we share the 50,000 in their proportion. So we share it into a proportion that this will take 200,000, this will take 20,000. So what we do is that the impairment for property, plant, and equipment will be calculated as the 200,000 divided by 270,000 because we are sharing it in that. Okay, it will be 220,000 rather. So 220,000 because we are sharing it in their proportion. So it will be 200 is to what? 20. So that will be 20,000 divided by 200,000 divided by 222,000 times the 50,000. This will be shared in their proportion. And then the patent will take 20,000 over 220,000 times the 50,000. So after doing that, then you now come and what? Determine the new carrying value now after the what? The impairment. So you determine the new carrying value. What will be the impairment loss on the PP? What will be the impairment loss on the PP?
4545.
Okay.
4.5.
Okay. So can we make it 45,000 what?
45,455.
Okay. So this one, the difference for this one will be 4,000.
4,545.
Okay. So this is the impairment. So you now come and reduce this 200,000 by this 50, this 20,000 by this. So you now determine the new carrying value after the impairment. What will now be the new carrying value for each of the assets? The property, plant, and equipment will be the carrying value less the what? The impairment loss. Allocated goodwill will be 0 because all the goodwill has impaired. The patent will now be 20,000 minus what? The 4,545. Then the current asset will still be the 30,000. That is how we go about it. All right. So let's finish first. Then we take some other questions. Maybe we can close at 7. We take some 2 questions for maybe 30 minutes or something. All right. Let's look at what we call the reversal of impairment loss. Okay. So let's look at the reversal of impairment. You see, we both agreed, or we all agreed that impairment test is carried out if there is what? A condition, or if there's an indicator of likely impairment on that particular asset. So we are carrying out the impairment test on an asset because of what? A condition that is telling us that this asset is likely to be impaired. Okay. If it is because of government legislation, it can happen that as time goes on, that legislation will no longer be there. So maybe we have property, plant, and equipment, or we have a plant, or we have a production facility that the government is saying that we cannot produce beyond 200,000 units on that particular what, or the government has passed a legislation that is restricting the companies to produce up to only 200,000 units on that particular production machine. But the actual capacity is 500,000 units. But there is now a law that is restricting us to produce only up to what, 200,000. So it means that the machine will be underutilized, and then legislation is now going to make the machine less efficient. So we are carrying out an impairment test on that. Okay. It might happen that after some time, the legislation will be withdrawn, and the asset will now produce up to its what, maximum capacity. You can see that the indicator for the impairment is no longer there. If the indicator for impairment is no longer there, what do? We have to what? Now revalue the asset again, because the asset will not be used at a full capacity. So it is likely that the value of the asset will now be increasing because the indicator is no longer there. It will now be useful. And this might happen that if the increase is there, we are going to realize maybe a gain. But how do we realize the gain? The gain must be realized to the extent that what would have been the carrying value of the asset if the impairment is no there, if the impairment has not occurred at all. What should have been the carrying value of the assets? And as a result of the impairment, what is now the carrying value of the asset? So the impairment loss, if you are reversing the impairment loss, then the reverser should represent the increase in the original carrying value. If the impairment has not happened, the increase in the original carrying value, if the impairment has not happened, compared to what? The carrying value after the impairment. So the difference over there, the difference between the pre-impaired carrying value, which is the impairment has not happened in the first place. What is the carrying value? And what is the carrying value after the impairment? So the only reversal that you can recognize is the difference between the pre-impaired carrying value and the carrying value under the impairment. The example, what I'm trying to say is that if the impairment has not happened, the carrying value of the asset should have been 20,000. But because of the impairment, the carrying value of the asset is now 18,000. So if the impairment is no longer there, it means that the asset must be accounted for as if there was no impairment in the first place. So the carrying value should have been what? The 20,000. But you are having 18,000 now. It means that you have to increase the 18,000 by 2,000 to have what? The 20,000 as the original carrying value. So the reversal of the impairment over here should only be the what? The 2,000, which is the increase in this particular value. That is the only amount that you can what? You can reverse. So the reversal should represent the increments in the what? In the impaired carrying value. The difference between the increments in the impaired carrying value and also the original carrying value. So if the impairment was not undertaken in the first place, what should be the carrying value and what is not the carrying value? So the reversal of impairment should only represent the difference between the pre-impaired carrying value and the carrying value under the impairments. So let me just take what the standard says about that. Let me just take that particular one. What the standard says about that. Okay. Okay, reversal of impairment. If the indicators that lead to an impairment is favorable result, then in certain circumstances, the impairment is reversed. A reversal of impairment law reflects an increase in the estimated service potential of an asset or group of assets. The increased service potential may be through sale or use. Any reversal of an impairment for an asset other than goodwill, okay, I'll talk about that one, should only be recognized to the extent that it increases the carrying amount of the asset to its original pre-impaired value less subsequent what? Depreciation. Okay. So what they are asking now is that, what they are saying is that, I've said that already, but why are we, if the impairment was 8,000, why are we not reversing all the 8,000? You can see that the impairment, if there is an impairment, the impairment is going to reduce the what? Depreciation of the asset. So now we are assuming that the impairment has not happened. It means that we should be charging the original depreciation. So the 2,000 over here is representing the portion of the impairment that is here to be what? Depreciated. So we take into consideration the depreciation that should have been charged if there is no impairment before we do the reversal. That is what they are trying to say. We do reversal for any other asset except what? Goodwill. So reversal for goodwill is not done. Okay, we don't reverse impairment on goodwill. Why? We assume that the increase in the goodwill is as a result of what? Internally what? Issues. Internal generated what? Issues. So the goodwill that we are talking about now is something that is internally what? Generated, which is being prohibited by what? The provisions of what? IS 38, intangible assets. Internally generated goodwill are not recognized because the cost of developing them cannot be separated from the cost of running the normal business. So for goodwill, we don't reverse impairment on goodwill because the increase in the goodwill is being attributed to what? Internally generated what? Goodwill, which is being prohibited from recognizing by the 38, which is IS 38, intangible assets. Okay, so let's pick a question on reversal, and all the talking that we are doing, we demonstrate it and see what is the issue about that. So let me pick a question on this one and see what we can do here. Okay, let's look at question 7 here.
On 31st December 2020, Felicity Limited had a CGU consisting of the following assets at carrying values: plant and machinery, motor vehicle, definite intangible asset, and goodwill. The remaining useful life of the assets as at 31st December 2020 is estimated as follows. We have plant and machinery for 10 years, motor vehicle for 8 years, definite intangible assets for 5 years. An impairment review was undertaken on 31st December 2020, and the recoverable amount of the cash generating unit was estimated as 180,000. There was no revision of the useful life of the asset. On 31st December 2022, a favorable change caused externally resulted in a recoverable amount of the CGU of 180,000. A further impairment review was undertaken on this date. How should Felicity Limited treat the above in the financial statement for the year ended 31st December 2020?
Okay. So they have given us the carrying values at 31 December 2020, and they have given us what? The remaining useful life of the asset at the same date, and they are now giving us the what? An issue concerning an impairment on that particular date too. So you can see the impairment review was conducted on what? 31 December 2020, which is the recoverable amount is what? Is 180. Sometimes they can also give you the net realizable value. You determine the net realizable value. They can give you the net realizable value and the cost to sell of each asset. So you do it for each of the assets and add them together. That will be the net realizable value for the total cash generating units. And they can also give you the cash flows to determine the value in use so that you can calculate your recoverable amounts yourself. They can also do that. Okay, but this one, they have given the recoverable amounts over here, which is the higher of either the net realizable value or the value in use. So the impairment was conducted on the same date that the carrying value was given to us. So it means that at 31st December 2020, the carrying values of the asset is going to be the same as this one. Okay, and the recoverable amount is 180. Let's deal with this question. Okay, so let's look at the carrying value of the CGU, the cash generating unit. Okay, the first item that we have over there is what?
Plant and machine.
Okay, so plants and machinery. Okay, the value is what?
100,000.
Okay, 100,000. The next one is motor vehicle.
Yes. 80,000.
80,000. Okay,
Definite intangible asset.
okay, definite intangible assets.
60,000.
50,
6.
60, okay, 60. Okay, the next one is what?
Goodwill.
Okay,
20,000.
so goodwill is 20,000. So the total is 260,000. Okay, let's come to the recoverable amount. The recoverable amount was 180,000. So our impairment of the cash generating unit would be 260 minus 180. And that will give us how much? Would that be 80,000?
Yes.
Okay. So let's look at how we are going to the allocation of the impairment. The allocation of the impairment loss. So the first one should be a physically damaged asset, which we have none. So the first one would be goodwill. Okay, the goodwill, the impairment is 80,000. So the goodwill, we have to write all of them off. So the goodwill, all of them will be, goodwill will take 20,000. So if goodwill is taking 20,000, it means that the remaining 60,000 to be shared among the plant and what? Machinery, motor vehicle, and then the definite intangible assets. You can see that we were not given, their next realizable value. So we assume that the goodwill should be shared in the proportion of their carrying values. So we have plants and machinery. Okay, let's look at the carrying value now. What will be their total carrying value? To be this plus this plus this. So that will be 240,000. So plant and machinery will be taking 100 over 240 times the 60,000. What are we having? What will be the value that we are going to get from this?
25,000.
25,000. Motor vehicle will be taking 80 over 240 times 60,000. What are we getting from motor vehicle?
20,000.
Okay. Definite intangibles. Definite intangible
15,000.
will be taking 15,000. Okay. So it means your total impairment will now be 80,000. Okay. The question is, after this, what will now be the carrying value of the assets? the carrying value of the asset now. So the carrying value, this is before, the first one is before the impairment. This one will be after the impairment. So we have
100 minus.
So we have the plant and machinery.
100 minus 25.
To be 100 minus 25. What are we having?
75.
Okay. Then we have the motor vehicle. To be 80 minus 20, isn't it?
Yes.
That will be 60. So we have the definite intangible. Will be 60
minus 15.
minus 15. That will give us 45,000. So if we add all, you get your what? 180,000. Okay. So let's look at what they are saying next. Okay. They are saying that on 31st December 2022, a favorable change caused by externally resulted in a recoverable amount of the cash generating unit of what? 180,000. So when was the next impairment review undertaken? It was 31st December 2022. That is 2 years after the first what? Impairment test. So what do we have to do? We have to determine the carrying amount of what? The carrying amount of the cash generating unit at the date of this one. So how do we determine that? We have to depreciate the assets by their value. So we determine the carrying value for each of the assets first. Okay. So let's determine the carrying value of the asset. Okay. So the carrying value, property, plant, and equipment will be, so let's determine the carrying value. Let me write the date here, December 31, 2022. Okay. The carrying value, plant, and so let me just short the plant and machinery, which will be P and M. Okay. So we can see that the carrying value is calculated as 75,000 divided by, okay, what is the remaining useful life on that date?
10 years.
It's 10 years. Okay. So 10 years. And we have done 2 years already, isn't it?
Yes.
So this will be multiplied by 8. Do you agree to that?
Yes.
Okay.
Yes.
So let's come to the motor vehicle. So what are we going to have for the plant and machinery? The motor vehicle will be 60,000 divided by 8 divided by 8 times 6. That would be 45,000 divided by 5 times 3. Okay. So for plant and machinery, what are we having?
60,000.
60,000. Okay. Motor vehicle is what?
45,000.
45,000. Intangible is what?
45. 27,000.
Okay. 27,000. So if we put all of them together, what are we having?
132.
132.
32,000.
Okay. So we are having 132,000. This is the carrying value. But what is the recoverable amount that we have?
180,000.
Okay. So 180,000. What is the difference?
48,000.
Okay. 48,000. Okay. So that is 48,000. Let's now come here. What was the impairment that was recognized? It was 80,000, isn't it?
Yes, please.
But since we are not reversing goodwill, it means that the impairment that was recognized on the asset was 60,000. But now there is a reverse of what? There is an increase of 48,000. So how do we go about the increase of the 48,000? What you have to do is that you first have to ask yourself. If there was no impairment, what should have been the carrying value of these assets? If there was no impairment, what should have been the carrying value of these assets? So if there was no impairment, what should have been the carrying value for property, plant, I say property, plant, and equipment? What would have been the carrying value for plant and machinery? If there was no impairment, what should have been the carrying value of plant and machinery? As
That'll
at,
be 100,000.
okay, the carrying value would have been 100,000, isn't it? That is that.
Yes.
Okay, but we are looking at the carrying value as at the date of the reversal. That will be 31, this one. So what should have been the
2020.
what should have been the carrying value? It should have been maybe
80,000.
it should have been 80,000, isn't it?
80,000.
Okay,
Yes.
because that will be a depreciation of 10,000 every year multiplied by 2 because we have done 2 years already. If there was no impairment, what should have been the carrying value of this?
60,000.
Okay, that would have been so. But we are going to look at it at this date.
Okay.
What should have been this? It should have been 80 divided by 8 times 2. Would that be 60? Okay, that would be 60,000. Okay, that would be 60,000. If there's no impairment on the tangible definite asset, what would have been the carrying value?
36,000.
36,000. Okay. So the question is, if there were no impairment, what should have been the total carrying value?
176.
One and what?
176.
176. Okay. That would have been 176. But what is the new recoverable amount now? What is the new amount now?
180.
Okay, so what you do is that you ask yourself, if there was no impairment, what should have been the carrying value? The carrying value of the asset would have been 176,000. Okay, and the recoverable amount now is 180,000. So you assume that there was no impairment in the first place, and this is the first time that you are coming to carry out the impairment test. So if you look at the carrying value of 176 against this one, you can see that there was no impairment at this date. So the impairment should not have happened in the first place. So what you do is whenever there is a reversal, you calculate the carrying value, assuming that there was no impairment. Then you will now ask yourself, if I should conduct an impairment test at the date of the reversal, would there be any impairment in the first place? So looking at the carrying value is 176. The recoverable amount now is 180. It means that there shouldn't be any impairment in the first place. So it means that the impairment should not have happened in the first place. If the impairment should not have happened, it means that our carrying value should have been 176. But what is our carrying value now? It is 132. So the difference will be 44,000. So we are going to be reversing the 44,000. So if you are doing reversal, assume that the impairment has not happened. Then you carry out your impairment test at the date of the reversal. So someone can also decide to add the goodwill to this one and be having 196,000. So you can see that the the carrying value will now be the carrying value will now be the carrying value will now be 196 compared to the recoverable amount. There will be an impairment of 16,000. So this 16,000 will be borne by the goodwill. That's why we don't reverse impairment on goodwill. So this will be borne by the goodwill, but the other assets will not be impaired. So what we do is that if there was no impairment, the carrying value should be 176. Then we now have our recoverable amount. So we now test for the impairment test as if this is the first time. So 176 against 180, there is no impairment test. So we have to now bring our carrying value to 176 by adding the 44,000 there. So what we do now is that we are going to be debiting the assets or the asset with 44,000, and we are now going to be reversing the impairment or profit or loss because impairment was treated as an expense. So we go and credit our profit or loss with the 44,000. Why are we doing the 44,000, not the 60,000 impairment? Because if we are assuming that the impairment has not happened, it means that the depreciation that we should have charged will also be taken into consideration. You can see that if the impairment has not happened, depreciation would have been 10,000 every year on plant and machinery. But after the impairment, depreciation is now 7,500. And that is for what? 2 years. If this is for 2 years, it means that we have undercharged our depreciation by 5,000. So 5,000, that is why we are reversing. That is why we are reversing only. That's why we are reversing only 20,000 out of what? The 25,000 impairments. That's why we are reversing only 20,000 because you can see now that our carrying value without the impairment should have been 80,000. So we'll be adding 20,000 over here, which in actual sense the impairment was 25,000. Why are we reversing only this one? It means that we have undercharged our depreciation in relating to plant and machinery to 2,500 for 2 years. So if there's no impairment, depreciation should have been 10,000. So we are going to be charging the 5,000 depreciation. If you take the same thing for motor vehicle and other ones, you see that the difference will be the depreciation. So what we do now is that we now bring our asset to the original value. So we bring our asset now to the original value. So we have plants and machinery will now be 80,000, and our motor vehicle will now be 60,000, and our definite intangible will now be 36,000. So we now have 176,000, which is indicating that no impairment has occurred on the asset. That is how we go about it. That's how we go about it. All right, let's look at what we call a corporate asset. A corporate asset. Let me see. I have examples on a corporate asset. Corporate assets. Okay, so let's look at corporate assets, impairment of corporate assets, and what we call a corporate asset. Okay, Some will say a corporate, corporate reporting, corporate reporting. It depends on the teacher who taught you. So corporate assets. All right. The corporate assets, maybe a company may be having so many divisions, and each of divisions, all of these divisions shared what? A one particular asset. It can be a research center, a research and development center. So the research and development center is for the what? The company as a whole, which maybe division A or branch A can have access, branch B can have access, and the headquarters itself can have access to it. So this particular center, which is a research and development center, we cannot say is for the headquarters, is for branch A, or is for branch B, because it's something that all the branches, all the companies have to use. So that particular research and development center will be called uh, a corporate asset. So a corporate asset is an asset that is being shared by what? So many business units of an organization. So we cannot say that this is for this particular company. It's just like a group and a subsidiary where they share a research center. We can't say that a research center is for the group or is for the parents or is for the subsidiary, because it is the group as a whole that is using it. So we can't say this is for the parents or it is for the subsidiary. In that case, that particular center, which is the research and development center, will be classified as a corporate what? Asset. So a corporate asset basically is an asset that is being shared by what? So many companies or so many subsidiaries or groups in the one particular company. So the parent has access, the subsidiary has access, the sub-subsidiary is also going to have an access. So we can't say this is for any of them. It is for the group as a whole. So that is what we call the corporate assets. So if there is an impairment, how do we test for what? The impairment on the corporate assets. How do we test for the impairment on the corporate assets? How do we test for impairment on the corporate assets? Okay, the first one is that you first have to test for the individual companies. You first have to test for the impairment on the individual companies. So you test for impairments. You test the individual CGUs. The individual CGUs. Okay, the individual CGUs. After testing for the individual CGUs, then you test for the group as a whole. Test the group as a whole. So the question will always give you the recoverable amount of the individual CGUs, and they will also give you the group of the company as a whole, or the recoverable amount of the company as a whole. The recoverable amounts of the company as a whole. All right. So how do we do this? First of all, you carry out the impairment test on the individual CGUs without considering the corporate assets. So after that, then you now test for the what? The group as a whole. You take the CGUs and also the corporate assets. Then you test for the impairments. Then you see what portion will be what allocated to what? To the corporate assets. So if the car generating unit of the CGUs, let's assume that we have A, B, C. Maybe their carrying value is 100 and 200. So they are now saying that their recoverable amount is now 90 and 180. It means that if you are testing for this one, A is going to be impaired as individual. It is going to be impaired by 10. And this will be impaired by 20. So they can now give you the corporate assets. They can give you the carrying value of the corporate asset to be maybe 20. And they can give you the value of a group as a whole, which will be maybe, they can give you a value of a group as a whole, which will be 1, which will be 180. Or not 180, it should be 270. or 280. Let's say that it's 280. They'll give you the value of a group as a whole to be 280. Okay. The question now is, if you are testing for the individual CGUs, they are having an impairment loss of 10 and 20. Now, if it's for the group as a whole, what will be the impairment loss? So you can do the testing at two levels. You can use two different approach. You can decide to find the carrying value of the group as a whole first, which will give you 320. Then you compare the 320 against the 280. That will give you an impairment of 40. But out of this impairment, A is taking 10, B is taking 20. So the remaining 10 have to be apportioned to the corporate assets. Okay. Another way of doing it is that you can add these ones. This plus this plus this is 270. Okay. So if you are testing for the group as a whole, this is the carrying value of the CGUs. Then you add the corporate asset to it. That will give you 290. Then you compare with the group as a whole, which will be 280. There will be a difference of what? 10, which is the impairment, which is relating to the corporate assets. So that is how we go about the corporate assets. Okay, sometimes they can also tell you that this one is because we don't know which portion of the corporate asset is relating to the individual CGUs. Sometimes they can give you that, they can tell you that the carrying value of the CGUs can be used as the appropriate proportion of the what? The corporate asset, or the corporate asset can be apportioned based on the carrying value of the individual CGUs. With that one, how do we find the proportion that is for? So if the corporate asset is 20, what portion of the corporate asset will be for the A and will be for B? In this case, we don't just stand up and use their carrying values. Okay. The corporate asset is going to be used by the what? The companies. The question is, how many years will this company be in existence? And how many years will this company also be in existence? So if you are going to, if A will be in existence for 10 years, it means that if A is going to be in existence for 10 years, it means that A is going to use this facility for 10 years. But if B is going to be in existence for 20 years, it means that B is going to use the facility more than what? More than A. Therefore, B is going to be having more of the what? The proportion of the what? The corporate asset than A. So what we do is that we use a weighted average. What do we calculate the weighted average? We multiply the carrying value by the number of years. We can't just use 100 and 200. If you're using 100 and 200, it means that these people are going to use the facility for the same number of years. So what we do is that we multiply the carrying value by the number of years, and we use that particular value to apportion the carrying value of the corporate asset. So this one will be 1,000, and this will be 4,000. So we share it based on 1,000 and 4,000. So it will be 1,000 over 5,000 times 20, and 4,000 divided by what? 5,000 times 20. That is how we do it. If the question says that you should use the carrying value as a reasonable representation of the proportion of the corporate asset, we use the weighted average method by considering the number of years the company is going to be using the facility. So we multiply the carrying value by the number of years to know the total value, then we share it. Then after that one, the impairment will still be the same thing. So you add the value of the corporate asset to the individual CGUs and test for the impairment by them. So if you add this, what will be the difference? So that will be the impairment. Very simple. Let's pick a very simple question, and we go. Maybe I'll come and solve the question that my brother was saying that it's not going to take time. I will solve it as a question on each wood. Okay. Or let me see if we can be able to finish this one. Then let me just take the Okay, let me just pick this very simple one so that we can solve that question within time. Okay, so let's take this example.
The structural group is made up of two cash generation units as a result of combination of various past 100% acquisitions, plus a head office which is not allocated to any given cash generation unit, as it supports both divisions. Due to falling sales as a result of an economic crisis, an impairment test was conducted at the year-end. The consolidated statement of financial position showed the following net assets at that date. So there's division A, B, head office, unallocated, total, goodwill, net current asset. The recoverable amount at the year end were as follows. Division A is 1,000, division B is 720.
Okay, so let me go to
The group as a whole is 185, including head office PPE at fair value less cost of disposable of 85 million. The recoverable amount of the two divisions were based on value in use. Fair value less the cost of disposal of any individual item was substantially below this. No impairment losses had previously been necessary. Required discuss with suitable computation showing the allocation of any impairment loss, the accounting treatment of the impairment test.
okay. Okay, so let's now come here. Let's now come here. So this is the unallocated goodwill, and also we have the head office. Which of them is the corporate asset?
The head office.
Okay, okay. So the head office is the okay. Go to following this one. Okay, okay. Let's come here. Let's come. So the first thing is we can decide to test for the what? The the group as a whole in the first place. Let's test for the impairment on the group as a whole in the first place. You can do that, or you test for the individual CGUs. So what is the carrying value of the group as a whole? What is the carrying value of the group as a whole?
1,009.
Okay, that is the 1,009 over here. But what is the recoverable amount of the group as a whole?
1,825.
Okay, so what is the difference?
75.
Okay, the difference is 75, which is the impairment loss. Okay, but let's now come here. Let's come to the individual CGU. This particular impairment will be allocated to the individual CGUs, the head office, and any other goodwill that we have. Okay, what is the carrying value of the first division? The carrying value is 1,020, but their recoverable amount is what? Is 1,000. So that means that this one has impaired by what? 20, isn't it? All right. The division B, the carrying amount is 760. The recoverable amount is what? 720. That means that it has impaired by what? 40. So the impairment of 60 will be relating to the two divisions. So remaining 15. Okay, the 15 now, the unallocated goodwill will take 10. The unallocated goodwill will take 10. And there will be a 5, which will be given to the PP of the head office. But the question also says that including the head office PP at a fair value less cost of disposal of 85. So it means that even if without doing this one, the PP is going to be impaired by 5, which is the difference of the 5 over here. So you only make this one to be 85. That is the difference. So this is how we do the testing for the corporate assets. Or you can do the testing separately, which will give you, you do loss of 20 on this one, loss of 40 on this one. Then you now use these values, 1,000 plus 720 plus 110 plus 10. Then you compare with what? This 1825. You are going to be having something like 1840 for this total. Then compare with 1825. There will be a difference of 15. This 15 allocated goodwill will take 10, and PP, property, plant, and equipment of the head office will take 5. That is how we share this particular one. That is how we share this particular one. All right, let me solve the question that my brother was talking about. I don't know whether he is here or not. Okay. Okay, question 10.
Any company limited has the following list of assets and liabilities.
Okay. Let's look at
Could
additional.
you patents
Let's look at additional information.
included in the plant and machinery is a plant with a carrying amount of 28,000, which is used to produce a special local food, mainly for export. Therefore, its cash flow are in USD. Its expected useful life is 3 years and it's expected to generate $7,800 per annum averagely, has a scrap value of 1,900 and expected removal cost of 3,100.
Nick, are you there?
And has an expected scrap value of 2,100. Its carrying amount included in the above carrying amount of motor vehicles is 12,300. The market value of the asset, the close of capital is about 2012 was 330,100 on the GST. It was believed the value in use for the entire entity at that date was not materially different from its market value. The cost of borrowing in USD to Ghana cedi as at 31st December 2010 is 2.1. The corporate tax rate show how the above will be treated in the effects of the year limited as a December 31st, 2013 in accordance with IRS.
Okay. Okay. So let's now, this is, I don't know why. My brother is finding this one very difficult, but it's very simple. Okay, one of the motor vehicles was involved in an accident on 31st December. Hey, why? No, this one, this supposed to be 2013, not 2012. Okay, the market value should be 2012, not 2013. Okay. The market value of this one, the stock exchange market, or this one. Okay. That should be the value. It should be 2013, not 2012. Okay. Let's take it one by one. Okay. Included in the plant and machinery is a plant with a carrying amount of 28,000, which is used to produce a special local food, mainly for what? Export. Therefore, its cash flows are in USD. Its expected useful life is 3 years, and it is expected to generate what? A USD of 7,800 per annum averagely, has a scrap value of what? 1,900, and expected removal cost of what? 3,100 USD. Okay. An expected removal cost of what? 3,100 USD. Okay. The question is, we have to determine the what? The value in use of this particular asset. I'm sure that that is what they are saying, that, okay, we have to determine, we don't have the net valuable value currently. We have to determine the what? The value in use of this particular machinery and see whether it has impaired or it has not what? Impaired. Okay. So the question now is, the carrying value in Ghana cedi is currently 28,000. But this machinery is used to what? Produce local foods for export. So the cash flows are being generated in what? USD. Okay. They are saying that this particular machinery is going to be generating a cash flow of what? 3,800 for 3 years. Okay. So every year is 7,800. Every year 7,800. Okay. All right. They are saying that at the end of this particular, at the end of this particular, at the end of the useful life of the asset, we are going to be removing the asset at a cost of what? 3,100 USD. And that will be an outflow. So what we are going to do is that whatever amount that we are going to be calculating, we should consider the value of the removal cost. So the first year, if we are computing the cash flow, okay, let me use bot. Okay, if you are computing the value in use of the machinery, this is question 7. I am so let's look at the value in use of that particular one, the cash flow, which will be in USD. Then we have the discount factor. Then we have the present value. So the discount factor was given to us as the borrowing rate of the company, which is 10%. Okay. So we have the 10%. So the discount rate is 10%. Let me do it for. So we have the cash flow, which will be in USD. Then we have the discount factor of 10%. Then we have the present value. Okay. So we have year 1, year 2, and year 3. So this would be 7,800 year 1, 7,800 year 2. Year 3, can we say that year 3 is 7,800 plus 1,900 minus 3,100?
Yes.
Okay. So the removal cost, it is a cost that you are going to be incurring at the end of the useful life. So if you are going to incur that cost, it means that you receive the cash flow, you use part of the cash flows to remove the assets, but you are also going to sell the asset at 1,900. So your cash flow for year 3 will be the cash flows plus the residual value minus the decommissioning costs. So the cost will be subtracted from that. What are we going to be having? What are we going to be having? 7,800 plus 1,900 minus 3,100. Okay. 600. Okay. So let's calculate the discount factor now. I'm sure that the first year will be 0.909. Okay. Second year will be what? Second year will be what? Okay. This does it mean that we don't have calculator?
0.862
0.862.
826.
Okay.
826.
Okay. 0.826. Okay. Last year is what?
0.683.
0.683. Okay. So what will be the present value for the first year?
Sorry, the third year is 0.751.
Okay. 0.751. Okay. So what will be the present value? Year one. 7,800 multiplied by 0.909.
7090.
7090. Okay. Year two is what?
6443.
6443. The last year is what?
4957.
4957. So what will be the total present value?
18490.
18490. Okay. You can see that this is all in USD. This is the present value of the cash flows in USD. So what we do is that we change it to what? To Ghana cedi by using the spot rate. So let's look at the present value in cedis. We change it to the Ghana cedi using the spot rate because this is the present value. So we use the today's exchange rate. So what is the today exchange rate over there? The spot rate for this one is what? 2.1. Okay, so 2.1. 2.1. So it means that one cedi is what? $1 is 2.1 Ghana cedi, isn't it?
Yes.
Okay. So if that is the case, it means that if we want to get the cedi equivalent, we multiply by the dollar. We multiply 2.1 by the dollar here. So we have the 18490 multiplied by 2.1. What are we getting?
38,829.
Okay, 38.
Yes, 38,829.
Okay, 829. Okay. What was the carrying value? What was the carrying value for this particular asset?
28,000.
Okay, and the recoverable amount is what? 38. So you can see that that particular asset has not impaired, isn't it?
Yes.
So we take it out. Let's come to, okay, one of the motor vehicles was involved in an accident on 31 December 2013 and has an expected scrap value of what? 2,100. Its carrying amount included in above carrying amount of motor vehicle is what? 12,300. So this particular asset has involved in what? In accidents. And we can now sell it for what? 2,100. So this is now the net valuable value. But the carrying value is what? 12,300. So what will be the impairment on this particular motor vehicle?
10,200.
Okay, 10,200. Okay. So the impairment, if there's an impairment of the motor vehicle, 10,200 will be for this particular asset. Okay, the market value of IEM Limited as at the close of 31 December, that should be 2013, was 300 330,100 on the Ghana Stock Exchange. And it was believed that the value in use of the entity as at that date was not materially different from its market value. So the value in use and the recoverable amount are the same. And the net realizable value are the same. So we use that particular one. So what will happen now is that we have to find the carrying value of the company as a whole. We have to find the carrying value of the company as a whole. How do we determine the carrying value of the company? Because they are telling you to find, they are giving you the market value. So you find the carrying value of the company as a whole. How do we do that? It is the total assets minus the total liabilities. Total assets minus the total liabilities. So let's do that to find the values. Let's do that to find the values. So let's add all the assets and subtract the liabilities from it and to get our net assets, which is the carrying value of the company as a whole. So let's add all the assets and subtract the liabilities. So let's add the asset to this side and subtract the liabilities.
Three seven three 800.
Okay, 373,800. That is the total value, isn't it?
Yes.
Okay.
I've factored the impairment of the motor vehicle.
No. You just add it. Just find the carrying value as if there is no
Okay.
impairment. Okay.
Then it's 384,000.
384. Okay. 384,000. Okay. So the question now is, what is the recoverable amount given to us? That was given to us somewhere here. 310, 100. So that was 310, 100. So 330, 100. So this is the carrying value and this is the recoverable amount. What will be the difference? What will be the impairment?
53,900.
53,900. Okay. This 53,900 have to be apportioned to this asset, the non-current asset. So, but before you apportion, you have to know that there is a machinery over here, which is 28,000. It has not impaired. So if you are sharing the impairment, you are not going to use the 76,000 because out of the 76,000, there are 28,000, which is not impaired. So what you are going to use over here will be 48,000. So it means that 48,000 of the value that is going to be impaired because we have a machinery over here, which is 28,000 that we have done an impairment test on it. It has not impaired. So that particular value should be taken from the 76,000 before you share your impairment loss. Okay. If you come to the motor vehicles too, okay, The motor vehicles, there is a value over here. There is a value over here, which is 21. What is that value? What is the value of what is the carrying value of that one? It is 12.
12,300.
Okay. So there's a value in the motor vehicle also over here, which is what? 12,300. And that we have done impairment on it already, and that is 10,200. So it means that out of this impairment, 10,200 will be given to that particular motor vehicle separately. So it means that that particular value of the 2,300 should not be included when we are apportioning the what? The impairment loss, because that one impairment has been given to that one already, 10,200. So if you want to know the value of the remaining asset that has been impaired, it will be the 50 minus the what? The 12,300. The same way for the 76,000. Where is the 76,000? For plant and machinery, we take it from the plant and machinery because that has no impaired. Okay. But if you come to the apportionment of the impairments now, goodwill will take 11,200. Okay. That particular asset will take 10,200, which is the motor vehicle, will take 10,200. What will be the difference? So 53,900 minus the goodwill minus the what? The 10,200.
32,500.
Okay. 32,500. So this 32 now will be shared among the remaining assets on the pro rata basis. So the patent rights will be taken as a 10. Okay. The patent rights will be taken as 10,900. Line and building, there is no elements on that. So line and building will be taken at 157,500. Okay. But if you come to plant and machinery, the plant and machinery, the value that you are going to apportion the impairment to will be 48,000. Why 48,000? Because 28,000 of this particular value is not impaired. So we can't include it and share the impairment loss to it. If you are including it, it means that you are telling us that 20, part of the 28,000 is also impaired. So we use the 76 less the what? The machine, which is not impaired as we have computed for. So plant and machinery will be 48,000. Okay. So that is the value. If you come to motor vehicles, the motor vehicles will also be the 12,300 of it has already been considered for impairment, which 10,200 of the value has been impaired. So what do? We take all the what? 12,300 from this. We take all the 12,300 from that. If we do that, I'm sure we are going to be getting 38,400. So the 12,300 of this one has already been tested for impairment. So we can allocate a further impairment loss to them. So this is the value that you are going to total. So to total it, you will now share the 32,500 in this proportion. That is basically about this question. That is basically about this question. All right. Oh, Seniors, any question? I'm tired.